All right, let's dive into a topic that is, let's be honest, a huge headache for pretty much everyone in crypto: taxes. We're going to get into the weeds and break down the crazy IRS rules for digital assets. But we're not just going to show you the traps. More importantly, we're going to show you how to use the rules to your advantage. So let's just cut right to the chase with a simple question. Could buying your daily cup of coffee with Bitcoin actually get you audited by the IRS? Yeah, I know, it sounds completely nuts, but this is what we call the Bitcoin coffee trap. And if you can wrap your head around this one idea, you'll basically get how the entire US crypto tax system works. Here's where things get really weird. To you, you're just, buying coffee. It's a simple purchase. But in the eyes of the IRS, oh, it's a whole other story. They see you selling an asset to get that coffee. And that sale, it is a taxable event every single time. And this is the reason why. It all comes down to this one little sentence from an IRS notice way back in 2014. They decided to classify crypto as property. Not currency, but property. That means it's in the same bucket as stuff like stocks, bonds, or even your house. And what happens when you sell property? Yep, you gotta figure out if you made a profit or a loss, your capital gain. Okay, so to really see how strange this is, think about it like this. If you're on vacation in Paris and the euros in your pocket gain a few cents against the dollar before you spend them, you don't pay tax on that. There's a $200 personal exemption. It's what's called a de minimis exemption. Basically, the government says, it's too small to worry about. But with crypto, since it's property, that exemption goes right out the window. So a gain of a single penny on that coffee, technically, you're supposed to report it. Let's actually break this down. All right, so imagine you've been buying Bitcoin over time, some cheap, some expensive. Now you go to buy that $6.50 coffee. The big question is, which Bitcoin did you just spend? Well, you have choices. If you use the first in, first out, or FIFO method, the IRS assumes you sold your oldest Bitcoin, which was probably the cheapest. Bam, you've got a $4.45 gain. But what if you use highest in, first out, or HIFO? You'd use the Bitcoin you paid the most for, and suddenly your taxable gain is just $1.71. Look at that. One tiny purchase forces you into a complex accounting decision that literally changes how much tax you owe. Now, let's zoom out for a second and see how this scales. If you make this a daily habit, one coffee a day, you're not just creating a tiny bit of tax. No, you're creating a full-blown administrative nightmare for yourself, because that's 365 different taxable events. Each one has to be reported line by line on IRS Form 8949. It's a lot. And as messy as all that sounds for us, the whole system is about to get way, way more serious. For a long time, crypto taxes have kind of been on the honor system. Well, that era is officially ending. The IRS is building a massive surveillance grid, and it's coming online fast. You can actually see how the IRS has been tightening the screws over the last decade. It all started back in 2014 with that property rule. Then, a few years ago, they added that little checkbox to the main 1040 tax form that every single American has to answer. But the real game changer is coming in 2025. This new Form 1099-DA means brokers, think Coinbase, Kraken, all the big ones, will start reporting your gross proceeds directly to the IRS. And a year after that, in 2026, they'll be reporting your cost basis too. There's nowhere to hide. And this new system creates what you could call a zero basis trap. It's really dangerous. Here's how it works. The IRS computer gets a form from your exchange that says you sold, let's say, $10,000 worth of crypto. Now, if you don't file your own forms to show that you bought it for $9,900, what do you think the IRS assumes? They assume you got it for free, that your cost basis was zero, and then bam, you get a tax bill for the full 10 grand. The burden is completely on you to prove them wrong. And listen, this isn't just about getting an angry letter from a computer. The head of IRS criminal investigation himself, a guy named Guy Fico, has basically put everyone on notice. He said that we're going to see more criminal tax evasion cases for crypto this year and in the future. So the message is loud and clear. The Wild West days are over. All right, I know, that's a whole lot of doom and gloom. But here's the silver lining. The exact same rule that makes buying coffee so complicated also opens up some really powerful strategies for you. So let's flip the script and talk about how you can use the rules to your advantage. First up, capital losses. So since crypto is property, when you sell at a loss, it's a capital loss.
And let me tell you, capital losses are your best friend at tax time. First, they can cancel out your capital gains, dollar for dollar. It doesn't matter if the gain was from crypto or stocks, a loss can wipe it out. Now, what if your losses are bigger than your gains? Well, you can use up to $3,000 of that loss to lower your regular taxable income, from your day job. That's a direct savings. And if you still have losses left over, you just carry them forward to next year and the year after that. They don't disappear.
And this is where we get to a really interesting and, frankly, huge advantage that crypto has right now. With stocks, there's something called the wash sale rule. It basically says you can't sell a stock to get a tax deduction for the loss and then turn around and buy it right back within 30 days. The IRS says, nope, nice try. But, and this is the key, that rule currently does not apply to crypto because crypto isn't legally a security. So what does that mean? It means you can sell your crypto to harvest that tax loss, claim the deduction, and then immediately buy it back. You get the tax break without ever giving up your position in the market. So yeah, tax loss harvesting is an absolutely massive tool for any serious investor. But let's circle all the way back to where we started. What about just spending it? Is there a smart way to buy back coffee and not get tangled up in this tax nightmare? Is there a way to escape the coffee trap? Absolutely. There's a strategy that a lot of people use. Let's call it the debit card swap. It's pretty clever. First, you fund your exchange account with regular US dollars. Then you use those dollars to buy a stablecoin, like USDC. Super important. Buying a stablecoin with cash is not a taxable event. Next, you load your crypto debit card, but only with that stablecoin. Now, when you go and buy that coffee, technically, yes, you're still selling property. But since the value of that stablecoin is pegged to the dollar, your capital gain or loss is zero. You're following the rules, but you've effectively neutralized the tax hit. So, look, the bottom line is this. The rules are getting tougher, and the IRS is watching more closely than ever before. But the key takeaway here is that with all this complexity comes opportunity. Once you really get that crypto is property, you can sidestep the traps, like with the stablecoin strategy. And you could also lean into it, using things like tax loss harvesting to seriously lower your overall tax bill. So the real question to ask yourself is, as this brand new digital net gets fully built out by the IRS, are you going to be caught in it, or are you prepared to navigate it?